Okay, team, welcome. I hope you're all good. Hello, Joe, H, whoever you are. Hope you're well. Just give it a couple of seconds, see if anyone else wants to pop in. This is the power of having things recorded, though, right? Okie dokie. So look, today, let me just reduce that. Can you just let me know? Is the volume okay? Can you hear my voice okay? Is it too low, too loud, too scouse? Can't say nothing about that last one, I'm sorry. Thanks, matey. Okay, so look, just a couple of house rules just before we get started. So look, the key thing here is I'm going to make some assumptions. I'm going to assume you don't know too much about trading, and if you do, great. If not, then this is going to be for you, because I don't want to just dive in too quick with all, jargon and technical stuff that's going to get people lost. The game here is to iteratively each week build on the content so that you've got a base to work from, and each time nothing gets too complex as we're kind of moving on. So last session we covered was just the basics of TradingView, so the navigation, how to kind of add different things. It's if you want to catch that, just go into my thing, and you'll be able to catch that up. But this one's going to be on volume profiles, and I was debating which ones to kind of move into next, because I thought back when I was first starting to trade, and I thought, what would I want to learn, and in what order would I want to learn things if I was wanting someone to teach me trading. And this is the first thing that kind of sprung to mind, and it's volume and the importance of volume, actually. So for me, when you're thinking about trading, the first thing you need to know is how to navigate a chart. When you first, doesn't matter if it's Forex, doesn't matter if it's, some indices, if it's a commodity, if it's crypto, whatever it is, it doesn't really matter. You have the same approach each time. And if you have that kind of same approach each time, it doesn't matter what chart you're going to come against, you're going to have a plan. So this is the way I kind of map things out, right? So I always like to know and have a guide on where I can expect price to go, or at least when price goes to a specific area, it's gonna get stuck, or it might reverse, or there's gonna be a point in which you'll expect a lot of volatility at specific areas. And the reasons that is key is because if you're putting a short or a long at a specific area, you want a good idea, specifically if you're swing trading, by the way, how far it's likely to go. So what I'm going to be showing you is something called fixed volume profiles, right? And again, on the last video, I kind of shown how you get access to all of these favorites here, but what we're going to use is this one here, which is the fixed range volume profile. And what this does, I'm just going to drag it from this candle. We're currently on the daily time frame, and we're seeing the whole price range of Bitcoin. Okay, now by doing this, if I take the whole, you can just see I clicked on the first candle here, and I'm just dragging it all the way back to the very beginning candle. And what this is going to do is put this on the chart. Right, now what this tells you is the bigger the peaks, the more volume is traded in that specific price range. So if I maximize the price here, you can see each one of these spikes represents an amount of traded volume, and purely just by eyeballing, I can see most traded volume, which we call the point of control, the POC, was exactly at 19,280. So across the entire Bitcoin price cycle, most volume is being traded at that 19,280k. So it's an important, that in itself is a very important figure to kind of keep in your mind. So what I like to do as a starting point is I like to map the peaks, not just have it on this this indicator, but I like to physically map them out. And again, you guys know I like to use my object tree. So the way I'm going to map it out is I'm going to just I'm going to take my rectangle tool, right, and I'm going to just have, let me just see how this comes on. Yeah, the way I've got my rectangle set up is if I just put my rectangle on the screen and just click the button here, I can double click on it, and then I can say, if you go to the style, you can extend the box right and left. If you don't extend it, it's just whatever the size you create. So I want this to go across the entire screen. And the reason I do it in this way, and I want the opacity to be quite low, because I don't want it sticking out on my chart. So maybe I'll set it to like 10% of the opacity, and I'll have it on white. And what I'm doing is I'm just let me just zoom in a little bit. I don't want it to be too wide, so I'll just keep it kind of nice and small, because I want to, this is going to be a zone effectively, and you'll see why it's powerful in a little minute. So what I'm going to do is I'm just going to map out all of the peaks, right? I know this is quite far down, but once you've done it once, you can kind of forget about it, right? So I'm going to go that one. I'd say that's a peak here. I'm just focusing here, if you can see, on the left hand side. Command copy, Command V, moving it up. And you don't need, at this stage, by the way, you don't need any technical awareness. You don't need to know anything about levels, what's a resistance, what's a support. All we're doing is just mapping out where the biggest traded volumes have been over the entire cycle. And again, you can do this on any coin, any token. If this was a video, I'd hit fast forward now. So sorry if you've got to watch this. It might be a little bit slow to do, but it's going to be worth it. Now, this is the point of control. So here's what I'll do with this one. I'm going to change the color of this one to red, because I want this to stand out like a sore thumb. Yeah. Now, key thing here, you'll notice there's nothing on this this blue line here, and you might have actually wondered, what are the blue lines? The blue lines, when we look at the the entire price range, we have two things, and these are very important things to note. We have the value area high, which is the blue line at the top, and we have the value area low, which is the blue line at the bottom, and obviously, as you say, the point of control, which is the middle one. Now, across the entire range, what the value area high and the value area low is 70% effectively of the range, right? So it will take 70% of the range and say, right, where's the biggest 70% of the traded volume across the entire visible range? Well, this is the visible range right here. We're seeing the entire Bitcoin price, but it takes the 70% of the traded volume and puts the high point of that 70% and the low point of that 70%. And these are what we call the VAL, value area low, and the VAH, the value area high, and then the POC, which is the point of control, which is essentially, as I say, the most traded volume. Now, the reason these are really important is psychologically, it's what traders always gravitate towards. Doesn't matter if you're a retail trader or institutional. Generally, there's an acceptance that these are going to be really, really key levels, whatever time frame you're looking at. So we're just going to continue. So again, we just want to just go Control C, Control V. I'm just going to drag this one down to the value area low. I'm going to color this one blue, like that. And then Control V, we carry on. Where's the next peak? It's just there. Now we can get a bit granular if we want with different visible ranges. I'll come on to that in a second. We're going to come on to some really good stuff in this one, specifically just around price action and how to kind of understand that. I'd say that's a little tiny peak there, so we'll have that one in. Not too far from where I want it actually, so it's about there. You want to try and be as precise with this as possible, because it represents where you might want to put a reversal or some sort of a, you know, if it's stuck within, what you'll tend to find, and what I'm going to show you in a second, is the area where where price trades in this area, we'll see gets very, very sticky, as in the price gravitates there a lot. And there's reasons why that is the case, by the way, and again, it's all to do with liquidity and to do with the ability for market makers to trade in and out without too much price slippage. If you're trying to move a lot of money, you want to trade in an area that has a lot of liquidity, and if you don't, then you're going to be subject to price impact, which is to say, you know, at different price levels, when the liquidity starts to get really low, if you're putting in a, you know, sub 3 million, 4 million, 10 million worth of Bitcoin orders as a market order, well, that market order is not going to get filled at the price you want, because there's, you know, just a really lack of liquidity. So a lot of the kind of, I guess, behind the scenes stuff is a lot of kind of trapping of traders to build liquidity in specific areas, so that bigger traders and whales can trade without too much issue. So that'll do us for now. I'll just do the value area high, Command copy, Command V, just up at this range for that. That's good enough, I think. So we're going to take this off the chart. Now, just if anyone wants to copy my settings, by default, it doesn't look like this. It might not look like this on your chart. If you want to know where to find this, let me just double check. This is why I build my favorites, because I hate having to search. Oh yeah, it's here. So in the 1, 2, 3, 4, 5, 6, 7 icon down, and it is bottom one, fixed range volume profile, if anyone wants to know exactly where to find that. Right, now we're going to take this off the chart because I don't need it no more. And now get into the habit, because we want to be good traders, of now creating. So we're going to copy all of these, right click, we're going to create a group, and we're going to call this volume zones, right? Okay, perfect. Now we also want to lock them, so that little lock there means that they're not going to move, which is great because it's a pain in the ass. Now what we're going to do, right, is we're going to just as a quick eyeballing exercise, because I think it's important, if we just go back to where's my replay tool? Let's say, I don't know, here, right? Now what we want to anticipate is, if we're trading here, right, we'll go down to like the 15-minute maybe. Fuck off. Right, so 15-minute, this is where we are. One of the things I want to do is I want to see, so we know this is what I would call a volume zone, right? Now on the 15-minute, because we were looking on the daily, this zone is now somewhere in the range of like 23,300 down to about 22,970. There's about a 300 or 400 point delta between the top of that zone and the bottom. Now what I'm looking to do from here is, I would be thinking, just logically, right, if I'm thinking about where I want to get into a trade or get out of a trade, I'd be really focusing in on this zone, because if we look back, the top zone hadn't been hit for, well, even I can keep going. I don't know how far back I'd have to go for the top zone, but it's probably going to be a while. So, but what I want to see is, when we came into this zone here, see, we just came just underneath it, but then hit it again, and then we thrashed through it. Of course, what happens? We bounce right at the top of that zone. So you're thinking to yourself, this is an area where you would look for a reversal. So if price starts to come back down, I'd be looking to long at this point. And we're going to test that hypothesis again, right? Remember, all we've done is we've put a volume zone profile on the chart, and we've mapped out where the peaks are. Nothing else. I haven't had to look at support, where we seem to create natural visual patterns of the eye, which you think are going to be like good areas. We're just literally putting lines on a chart, right? And now we just want to go and press play, and let's just see, do we come into these areas? So, my version of well, that's a bit of a shame. I need to upgrade my bloody license. Anyway, that's a shame. Doesn't matter. Right. The point I'm trying to make is, right, what we would have probably seen if someone would have paid the bills is it had bounced off this zone and then maybe came up to this zone and bounced off this zone. What you tend to see time and time again is, like you can see right here, we hover and this is a very sticky zone, right, which means a lot of liquidity is traded across this zone. It's just great for where, accumulation or distribution. So this phase, let's just say, where you get, it's ranging top and bottom, and it's fantastic for, like, if you start to see a range here building up, like you can see, like we hit the bottoms a few times here. They're just really good points to start a range from, and we're going to probably hit this and spend a good few days, weeks, even months in this specific area, simply because it's a zone of value. It's a volume zone. It's a zone where market makers like to kind of trade in and trade out of. So just setting up some basic support and resistance at these points here would be ideal. You'd maybe put one up here just as an example, and you'd maybe start one down here. Now what you'd be looking to do is nice and easy, as basic as it gets, is take a short from the bottom and take a short from the top and a long from the bottom, and you just trade these ranges until such time that you get a, you know, a breakout. I'm not talking about a fake out here, a breakout. And the way I would look at this is I wouldn't be trading the top. I would be trading just below, right? Because at some point you get these fake outs here, which are these, you know, these kind of ones that look and appear like they're going to break out and go to the next zone, but actually they don't. And a lot of the time what you see is high volume like this. You can see the high volume coming in here, and on here high volume, but ultimately it's on a downward spiral. So even though the volume looks high, it's 1 or 2 candles. I mean, we are on 15 minutes, so you'll have seen big push to the upside, grab liquidity, because there'll be a lot of people who put the stop losses here in these zones. It's classic. It's exactly how the market likes to trap you. And the other thing about this, by the way, is when the pushing is going in here, if I'm a retail trader, let's say, and I'm a breakout trader, well, that's my engine room now, because I've broke through this barrier, which I thought was a nice, you know, nice line of resistance. We've broke through, so now everyone's aping in for the long, but then big money comes in, yeah, puts it back down as a short. You know, these are only 15-minute candles, and that's not really a breakout. It's actually a fake out or an up thrust, if you Wyckoff guys will indulge me. But anyway, moving on. So the point I'm trying to make is these zones are hugely important. I mean, if we go forward right now, like, let's just bring this to where we are today. Okay, so let's say we're now, where are we time wise? Yeah, so we're here, right? This is the live BTC price. Now, for me personally, we're currently on the 15-minute, and you can see we've been, I think, when was the last time we looked at this zone, right? This was the top of the zone, wasn't it? Let me just go to the 4-hour. Right. So you can see that zone there. You can see here, this was the zone when we had that huge push to the downside, right? So it's like, okay, well, this is clearly, if I was going to look at where we potentially, if we pushed up now, this would be a really key zone. Kind of that 26,400 to 26,800. Now, clearly, you've got to appreciate that we've got a bottom here, which is where we sprang from, come back up, hit the other zone, come back down, smash through the zone there, smash through the zone, hit the point of control, and then we started to kind of come back up to these other zones. But what I'm looking for is, now thinking about it, the market structure is, okay, well, very good chance of just with the volume zones alone is that we'll maybe come down, test this zone here, grab a ton of liquidity, because you can see we've got a lot of traded liquidity in this zone, and then push back up to the upside. The reason that that's very possible is because we have a lower low, we then have a higher low, we have another higher low here. This would then create another higher low. So in terms of bullish structure, that would still be very bullish in terms of, even though right now it looks bearish, on the macro, it's very bullish. So I could see certainly that playing out. The other thing I could see playing out, and this isn't for another day, but maybe we come past this zone with high volume. It's always about monitoring the reaction. That's the key thing. When we come down to this zone, do we respond with a huge amount of high volume? If we see that, then ape in, because longs are very much on the cards. If the volume that if we have a small bounce, and this is why volume is very key. If we have a small bounce, if we come down to this zone here, this 23k, let's just say, but the volume, we get a small reaction and the volume isn't great, then that's not great at all for if you're a bull, because what it's going to mean for me is then we're going to come potentially down and retest, you know, this 20k zone here, and then if that gets broken, of course, we come to the mother of all mothers, that the POC, point of control, which is down at the 19.2. Now, that's the biggest traded volume of all, where most money exchanges hands. So, you know, I could make a case for that too. So that's not, you know, I'm just, when you're trading, everything is about the reaction. Honestly, it's the biggest advice I would say is like, you know, the relationship between price and volume, let's just say. So as an example, let's just do a quick little bit of analysis. Let me just get rid of that. Like, if we look at the volume here, what can we see? just candle by candle, right? So let's take this candle here, right? This candle in isolation. I hope you can see that. Its corresponding volume is here, right? Now, what would you say about that? I would say, okay, fairly decent size candle from wick to wick, and it's matched by its volume. I would say that's in harmony. So the candle represents the volume in terms of how I'd expect it to look. Tick in the box, no divergence. What about the second candle? Well, I'd say the second candle looks smaller in size than the previous candle. I think you'd agree with that. But I would also say that the second volume is proportionate to that. It's also still small. So I would say in harmony, there's no divergence, as in it's not going against the grain. But what about the third one? So then the third one is, well, I'd say the third one is bigger in size wick to wick, but the volume is actually smaller. So there's our first clue of divergence. That means it's taken less effort, right, in terms of the volume, and the actual candle is bigger. Now, what that actually means is that the bears at this candle here have not been too interested in fighting this candle specifically, because the volume's low, and the price has been quite easy to move it, which is why it's only, the way we'd anticipate, or we read that, is that you would say that, and that's very much just a small corrective candle. This is on the 4 hour, remember. So these candles represent a lot of traded volume in 4 hours. But just reading that candle volume tells me that is nothing more than a retracement, a correction, because you've got, smaller volume than the previous, so the volume is reducing, but the candle is a bit bigger than the one prior. So you've got more price action in this candle, but less volume. That means someone's stepping away. Now, for me, it's the bears, because they haven't really done too much. And then, of course, what happens? Next candle comes in, even lower volume, but the candle's even bigger. So it's taken even less effort to push the price down. So now the bulls are really starting to weaken at this stage. And then if you look at this candle, price comes back up, but it's not proportionate. I mean, that candle's probably about the same size as that candle, but the volume is certainly disproportionate to that, which is why we've seen slight little retracement on the next one. So it's not in harmony in terms of its volume, in my opinion. But anyway, that's just a kind of, I'm probably going too technical in the sense of thinking about volume and price action, but just know every candle tells a story. There's a relationship between the size of the candle, the price action, which is obviously the candle, versus the volume. Now, usually, just kind of remember this in your head. If you start to see volume dropping, like we can see volume starting to wane a little bit now, and from a divergence perspective, what we're seeing is actually price is going the opposite way. Now, what that tells you is there's a divergence. Volume's dropping, price is going up, but it's taken less to push that price up. That means, in reality, that there's the bears are kind of thinking, okay, well, I'm not interested in pushing you down at this price. I want to get a better value. And then at this point here is where the bears have stepped in and said, right, okay, I'm happy to start pushing you down at this price. And just as another kind of note, look at this price, look at this level here, just this level. We've had 3 touches. These are all 4 hour candles stemming back from the 16th of February. So had to go there, couldn't get through. Had to go there, couldn't get through. Third time's a charm. And at that point, it's like, okay, volume is dropped, showing signs of weakness to the buy side. Because look, each candle's getting slightly less in volume. Don't worry if that doesn't make sense to you, but just think of it like in an abstract way of saying, well, it's taken less volume to push the price up. That means like there's no more buy side liquidity or on limit order sides. It's like we're not really bothered trading at this price anymore. It's not valuable, and that's when the bears then step in. That's what that kind of tells me as I look at the volume dropping. So the way this can become a lot clearer, by the way, and I'll show you. This is something that's I think this was a step change in my own trading knowledge, I have to be honest, because when I saw this, it's like I guess a light went off in my head about understanding things deeper in terms of, you know, behind the scenes, what you don't see, because you see candles and you see volume, that's great, but what does it actually all mean? So, you know, I'm going to show you Bookmap, right? And it's all pertaining to volume. So in terms of volume, right, one of the things, if you look at this, you know, this is showing you the exact same data as what we're looking at there on TradingView. We're just looking at it in a very different way. So what you're looking at here is Binance's order book, right? You're seeing two different types of orders. We have what we call market orders. These are aggressive orders. These are everything. If I want to go and buy Bitcoin now on futures, and I want to just pay, I put a favor just getting me order filled over any kind of fees. I'll just put a market order in, and I'll just pay whatever the bid ask is. So I will pay whatever that would be. So the difference between the bid and ask now is yeah, it's not a lot, because we're very liquid in this market. You can see the red is the ask and the green being the bid. So if you just do a buy order, you'll be one of these bubbles, right? Because these are just market orders. What you're seeing here in the red and what you're seeing here in the green are passive orders, or known as limit orders. These are orders that I will put in and say, okay, I might want to get filled at this 23,880 because I want to reverse order. So I would put a short order in, and let's say I put 3 Bitcoin. I wanted to sell 3 Bitcoin or short 3 Bitcoin, because obviously in our world, in the futures, you can short as well as long, yeah? Now, if I put my order in there, I'm going to add to this liquidity. And what that's basically saying is at this level here, where this red heat map is, let me just go down a little bit so you can make this a bit clearer. At that level, at this level, it's now yellow, because what it does, the way Bookmap works, is it looks at the size of the orders that are sitting on the order book, and it will weight by color. So it's a heat map. So based upon, you know, right at this 23,400, we have 945 Bitcoin waiting to be, you know, absorbed by the market. And up here at this level, you know, we've got like 278, so it's yellow. Now, one of the things, this is exactly what market makers do, right? So you can see above this VWAP line here, this white line, the order book looks very thin, right? And what that means is you can see, you know, staggered orders of like 278 here, 183, you've got 88 Bitcoin there. These are all sitting on Binance's order book waiting to be filled. Now, what I was saying to you before is if I go and put, if I want to buy 2,000 Bitcoin right at market, well, look how much liquidity is currently at 23,800. There's like 150 Bitcoin, and then above that there's like 230, well, 23,820. Above that we've got 220. Above that we've got 98, so on and so forth. So I want to buy 2,000 Bitcoin, right? Market order, and that's not out of the question. If I go and buy 2,000 Bitcoin at this price at a market order, what I think I'm getting at 23,800, I'm actually gonna spread that 2,000 right up to there. So I might get some actually I might, for my market order of 2,000 Bitcoin, I might get some of them at like 24,080 and some of them at 23,800. So the spread between what I want to buy it at and what I actually get is a multiple of wherever the liquidity is across that order book. So when you think about it, right, kind of taking the veiled mask off of how markets work, if I'm a whale or if I'm a big player, I don't want to be trading where liquidity is low, because for two reasons. The first reason is if I advertise, let's just say where my 2,000 Bitcoin orders are, well, the market might not want to go down there, because simply it's going to be absorbed. Because think about it, if I've got 2,000 Bitcoin as long orders sitting at 23,400, well, for me to get them filled, I need aggression from the market to push the price down here enough to take the whole 2,000 Bitcoin if I want to get that there. So it's very difficult for big players to trade. So what they do is they build orders on the way down with smaller shorts. So you're seeing all these limits here. So very, you know, let's say I wanted to trade 2,000 Bitcoin, you know, up here, I would be building shorts as the price is going up. So I've got limit orders, yeah. So limit order. Let's say I'm a market maker. I've got all my limit order a whale. I've got all my limit orders being built up here, which are passive. They're just sitting on the book, not fulfilled. And then at this point, I might just do a really large order to start the momentum of the price. Now remember, I've got short orders built all the way up here. So if I do a big order at, like, say 500 Bitcoin, 800 Bitcoin, that might signify some form of a move to the upside. And this is exactly what a fake out is as well, by the way. You know, it's some sort of a push to the upside. And then if I'm a retail trader, let's say, who, like, yeah, let me solidify this concept really for you. This is a powerful concept to know this. Let's say this is a range, right? Let's say that's the range there. And that's where we're trading, yeah? And at the top here, let's say the price of Bitcoin, where's my, let's say the price of Bitcoin kind of does this and whatever, and then we'll kind of hit this zone. So we've hit it we've hit it here, we're just shy of it there, and then we've hit it here. Now we're coming up for the fourth time, right? So you're thinking in your head, okay, this time it's going to break through. This time it's going to break through, right? So you're waiting for the break and then the retest, and then you're thinking it's off to the moon. So here's what happens. If I'm a market maker, I know that I need to trap liquidity. I know that I need a lot of people, because remember, I want to wash 2,000 Bitcoin. That's, you know, my hypothetical situation. So going back to Bookmap, let's say we're at this price here, and on Bookmap, sorry, I didn't realize it wasn't on TradingView. Let me just explain what I just said there. So going back to, like, on TradingView, you can see, let's say hypothetically, this is the range top, this is the range bottom, and the price has been, you know, ranging in and out of this zone for the last few days, but we start to see the price come up to this point here, right at this top of this range, and we've got, you know, you've seen it hit it once, you've seen it hit it twice, and as a retail trader, you're thinking, okay, this time we're going to smash through here. We maybe come down, retest the zone, and then, you know, we're off to the races. But this is exactly the mentality of the way people want you to think, at least the way the market makers would like you to think. So taking that into consideration, right? Let's say we are at the zone. Let's say price is just about getting here now. So then we're going to move back over to Bookmap. Now, we're going to say on Bookmap that's that same zone, right? Now, what a trader, what a market maker will do is, let's say we're coming to the top of the zone. Remember, this white line now represents the top of that zone. They will have built lots of shorts all the way up here, and then they will initiate a move with a fairly large order, maybe like 300, 400, 500 Bitcoin at this stage. That will break the zone, yeah, and then, you know, you'll get a few people short and come back down, and then they'll hit the zone. They'll hit more buys to push the price back up again. So remember, the buying as buys, but they've got limits orders as shorts being built here, because what they're anticipating is that, number one, a load of people's stop losses will get triggered who are looking to short just above the zone. Sometimes that creates like a cascaded liquidation event as well, where the price starts to really push up. So as the price is pushing up, remember the limit orders that the market makers added in the book here are all getting filled as short orders. And then, of course, by the time it hits the top, where everyone's aped in for longs, there's plenty of liquidity as pure aggressive market orders. For the market maker to then just go, boom, 2,000 Bitcoin order. This is just illustrated figures. And then the price comes whipping straight back down. We call that obviously a failed move. And the reason it's a failed move is, and the reason it's all about the kidology of trapping people is to signify that you think the price is going to go out, but actually it doesn't. The price goes out for a bit, but it's all around, you know, the reversal. So the way you look at clues about that is, like I said, you know, going back to TradingView, what I always like to do is, it's all about volume, right? So we're seeing the volume starting to drop, and then when we approach here, what you want to see is a huge volume spike, right? Followed by imbalances, right? I'm not going to talk about imbalances right now, because it will it will kind of throw people off. But what you tend to see is big push to the upside, right? No more sell side liquidity, so you see lots of zeros on the sell side, and we're going to pick all of this really technical stuff up down the line. But what it gives you as a trader is, wow, okay, we're starting to see exhaustion on this buy, and now we can. It's the perfect reversal basically, and you see it all the time. So the way I trade and the way I like to trade is that counter trend reversal, waiting for these kinds of zones to be built, because we all make patterns with our eyes. We all see these kind of patterns and think, right, okay, here's a pattern that I know people are going to be short and long, and at the top and the bottom, they don't anticipate how far the zones could go, and what we're going to kind of cover, on the journey of these workshops is how we can expose and identify these things. And some of them are more technical than others. Some of them are quite basic, but still, it's important to kind of understand them. So yeah, I think that's pretty much it. So I mean, this really was about, if I was to kind of cover what this session was about, is about volume, understanding just with the naked eye, to give you some sort of a framework and a reference of where price could go. Like, think about this. We've just talked about that we can suggest that this is maybe, a level being built, but on the 4 hour. So we've had some nice touch points at this zone. So we've created in our little minds that this is now a construct of a zone or a channel. And the key thing here is, it's like, okay, well, if we're going to get a fake out, where are we likely to go to? Anyone? If price pushes up here, now remember, everyone is putting their short orders here, right on the zone, or even below here, and maybe in fact, that's probably what more likely that they're going to be doing. They'll be shorting here because they think, okay, we keep coming to the top and then we reverse back down. So what we're going to do is we're going to keep putting our shorts here, and we're going to put a stop loss there, right? Where do you think the most likely place, if we're going to break out of this zone as a fake out, where do you think the most likely place we're going to fake out to? Anybody? Okay, well, I think this would be the place where we would expect a lot of difficulty and where we'd get sticky, because if we faked out, we push price here and then come back down and then maybe come and test the zone. I don't know, but this is, for me, it's like, as a trader, you're thinking, where am I going to take profit? If I'm going to fake out, where am I going to take profit? Where am I going to put my short entry? If we come out of this zone, where am I going to start shorting from to get the best possible price? Well, there's a very high likely probability, because it's a thesis that you've put down, because over the past, since Bitcoin's arrival, that this zone specifically and this zone specifically is where there's an awful lot of volume traded. So there's going to be resistance at this level. So straight away, you've got an idea and a plan in place to be able to think, okay, well, that's where I'm going to put my short, and there's a good chance that I could actually go there, because we could fake out, wash everyone out who's been putting the tight stop losses here, and that's where I'm going to get my order filled, and then a price comes back down, and that would be a good 4,000 or 5,000 point move, by the way, as a swing trade. That would be a lovely move as an example. Now that's one thing. Now the other thing that is important to note, and again, two things you're going to learn on this, right, which are really powerful concepts, and obviously anyone in my own server will be very much aware of this. We're just going to get rid of that. We're going to get rid of that. We've got our volume zone here. We're going to take that off the chart right now. What we're going to do is we're going to jump to the daily. Please make sure you do this, and you will not regret it. I promise you that. We're going to mark out reversals on the daily time frame, right? And we're only going to cover a small area just for now. We're going to cover maybe this area, okay? Just because it's the traded range, we're going to range from, I don't know, we'll say 26k, right, down to about, let's see, we'll cover this range here, right? So that's covering this little snake bit, right? And what we want to do now is we want to just do what we call key high term time frames, right? And the power of these is phenomenal. We're going to use the horizontal ray, and what I'm going to do is I'm going to put my magnet tool on here on the left hand side. So click my magnet. That means now when I'm moving around, the crosshairs get stuck to the areas I want, and what I'm looking for is the candle body open of a change of direction. So what do I mean by that? So you can see here, this is the start of a new direction. We've gone from a kind of a bearish candle to a bullish, and then another bullish candle, and then we reversed down back here, and then we reversed again. So each time we reverse, I want to mark that specifically on the daily, because the daily is a key time frame, right? It's not like a 15-minute or 10-minute, whatever. It's a daily time frame. So there's significance in these levels, just like there is on the weekly, and even more so on the monthly. So what we want to do is just mark this off. So we're going to say, okay, let's work back. So this is the first reversal. Yeah, so 2 red candles that follow a green. So I'm going to mark the first red candle, and I'm going to template this as a daily, right? So here I have mine templated, and the way you template it is you just right click on it, you choose whatever color you want, you write a bit of text, whether it's bold, whether it's whatever, you determine what it is, and then you hit this little template box, and then you save as, and you give it a name, and then each time you add a new horizontal ray, which is what this is, it's that there, you will be able to label it. So now that's our daily time frame. I'm going to add the next one, which is here. Okay, but I'm not going to use this one. The reason I'm not going to use this one is because we've already smashed through that daily time frame. You can leave it on just because it might come back and retest. That's whether you want to see how reaction happens at that zone. I would probably not have that one on. In fact, I won't have that one on for now. But we did smash through it, and we smashed through that one. My next one would be here, right? I would have a daily time frame there. Right click, template, daily. Gets really quick once you get into the swing of these things. Next one, that was another change. Template, daily. Next one, down here. See, that one is already done. Template, daily. Let's do a few more just to illustrate. One here, daily. Let's see. Yeah, well, that one, daily. You have less and less of these as you build. Well, as the time frame gets longer, let's say. So weekly, you're not going to have nowhere near as many. Now, the power, I won't do that one because it's too close to this one. And usually the way the rules are, if there are 2 that are very close, you take the nearest one to the current date. So remove that one. I'll just add one. I'm not going to add any here because it's too close to that. I'll just add one at the bottom. Right click. What's the template? Going to call that daily. And we're just going to highlight these. Right click. Create a group. Rename. Daily. High term time frames. Okay, I'm gonna just get rid of them a second, and then we're gonna do. I'll show you the power of this. By the way, it's not a worthless task. So weekly, again, we're only covering the key points. Again, I'll just do here. Template weekly. I just have different colors for different days, different time frames. Got one down here. Template weekly. Remember, it's the body. It's the body closed that we're focused, or the body open or closed, depending on what it is for the reversal that you're interested in, not the wick. Weekly, we're not too bothered about here, it's too far down. We'll just do one here. Template weekly. Yeah, we'll do one here very quickly. No, we won't, because this one's there. We won't do that one because that's there, so that's good. And then we'll just move on finally to the monthly. We'll just link these for just so we're keeping things neat. Rename weekly high term time frames. Job's a good one. And then lastly, we're going to go to the monthly time frame, and there should be very little of these actually. In fact, two. Got one here. Right click, template, monthly, and then we have one here. Monthly. Now, watch how powerful these are. Okay, so we're gonna, just for consistency. Okay, rename visual, create group, rename. Let's call these monthly. Okay. Item time frame. Okay, let's take that off. Right, now I'm just gonna go to the, I'm gonna get rid of this, not really relevant. Okay, and we're gonna go 15 minute. We're gonna zoom in, not that. Okay. Let's zoom and focus in on, say, here. Now what we're going to see now is how well do we respect these key term timeframes. Let's start with the daily. Right. Now, remember, for us, right, this daily time frame was created all the way back here. Okay, so this was, remember, this is where we had a reversal. Yeah, this was created at midnight on February the 23rd. Makes sense, new day and all that. First time it got tested was here. Nice reversal. We went at this point from 24,333 up to 25,317. Now, you know, I don't know how skillful you think you need to be just to map out a couple of high term time frames just on the reversal of the body. But, you know, between creating, let's put our zones on. So now we've got a bit of confluence being built now, yeah, as well. We've got two ideas now that are starting to filter through. We've got key time frames and we've got zones. So look at this. First zone. Let me get rid of that magnet. Come down, touch that to the almost to the dollar accuracy. That would have been a beautiful long as a reversal. Order that came in there. Of course, then what we do is we smash through it, smash through another time frame. But where do we come to? Right at the volume zone. And we push back up. And then we kind of bounced, hits the daily key term time frame there. And then again, we just kind of come up. And then it's like the power of these time frames is like you don't really need to know what's like a resistance or a support zone. You just know that you're gonna see a reaction around these zones, and you can see here and here. It's not always, you know, not every single one is perfect every single time. How can it be otherwise? Everyone would be a millionaire. We have to think logically around confluence, right? So how many of your ideas that you're putting together in terms of these concepts that you're laying out come together at the same time? Like, is it a volume zone? Is it a zone where a lot of volume's traded? Have we got a key high term time frame? So let's take these off. Let's see what the weeklies are like. Let's see if these are any more powerful. Okay, we're going to take the daily off. I'm going to go with the weekly. So now we've got the weekly. So again, you know, once we come down to that zone, we kind of hanged around the weekly zone for a little short while before we then start to rocket back up again. Then we get a fake out past the weekly level. That's a new weekly level that has started. We don't quite come down to the new weekly level or the older weekly level, but we bounce off it. But then again, so now we're kind of between these levels. So I would say like this, right? So if, as you can see, price is starting to push up a little bit now. I would be wanting to monitor where the reaction at this zone here. Okay, 24,266. It's a powerful zone. You know, we tried to break through it there, but then we couldn't. Then we smashed through it, comes back and retests the zone, comes back down, comes back and retests the zone. Then we come back to a new weekly or the older weekly level, and now it's trying to push back up again in what looks to be some sort of like a crab harmonic. So I would be wanting to see reaction at this zone, and for me, a potential idea to short, yeah, for value. If it fails here, if it doesn't break through again on this third time, I would be aiming down here. I would be looking for this 23k volume zone here, because 3 attempts to break through the weekly level would be, and that is normally a sign of weakness if it can't get through. Okay, let's have a look at the monthly. So monthly level. So we haven't really tested the monthly level yet, but that would provide 2 good ideas, wouldn't it? Number one, we've got a monthly level here, and it's a zone of liquidity. So you're going to have liquidity right underneath this zone here, right? I'm just going to mark that on the chart. The reason this is liquidity, by the way, is because it's the lowest previous point at what we call the pivot low, or the local pivot low. And the idea being that just underneath here, if anyone's been long at this zone, probably have relatively tight stop losses. So underneath this whole area, you're going to probably find it's a lot of liquidity in that zone. So you can absolutely make a case, you know, if we look at our weekly level here and here, come back up, try to retest that zone, don't break through it. We could break through it, by the way, but if we don't break through it, come back down. We'll certainly give this another strong test, break down, come and grab the liquidity, hit the monthly level, and then respin back again. It's just level to level. If anyone says, what type of trader am I? I'm a level to level trader, because I like to look at levels, and I like to look at multiple confluences, multiple ideas, and then look at where, like, okay, well, how many other people have got the same idea as me in terms of that? Okay, well then, if I'm a market maker, this is how deep you've got to go down the rabbit hole. But if I'm a market maker and they know everyone's probably got these same ideas, well, then how do I think outside of the box a little bit? And it's like, okay, well, where, if I was putting my order, where would I put my order, and where would I put a stop loss? Okay, well, maybe my stop loss is where my order is going to be, and my stop loss will actually be a lot lower than that. So it's just, yeah, thinking a little bit logically around, well, where am I likely to get a reversal? And these volume zones, volume profiles, weekly levels, high term time frames, this is a tiny bit of what we've, you know, discussed and talked about, and we can get a lot deeper than all of this. We haven't even used really any indicators at all. We haven't talked about, you know, RSIs, money flow index, EMAs. We haven't talked about order blocks. We haven't talked about supply and demand zones. We haven't talked about Elliott waves. We haven't talked about any of the good stuff that is really to move you on. All we talked about first session, we talked about platform, as in navigating it. This session, we've talked about levels, volume zones as levels, and high term time frames as levels. And you can just see, just with those 2 things alone, with no technical expertise other than being able to know where the body of a candle changes as a reversal for mapping a daily, a weekly, and a monthly, and then using the fixed volume profile across the entire landscape of the Bitcoin price to figure out exactly where most traded volume has been, and therefore how likely price is going to go to that zone. Because we know, based on the market, how the market maker likes to push price and where he likes to get in and out without too much slippage, that's where he's going to try to drive price to. Yeah. Either I've done a fantastic job, or people don't need to ask any questions. Either way, it's a tick in the boxes, I see it. So are there any questions, or are you guys okay with everything that we've covered? Okay then, gang, I think we shall leave it there. Thanks for anyone who's watched. I guess I'll see you guys in the next one. Have a lovely day, and or night, or whatever, wherever you are, and I will see you guys soon.